GetCrack. Wake up, motherfucker.
Is this retail sales number?
Well, we wouldn't read too much into it. We do think the economy is slowing. We're not expecting anything particularly good from that number. You had consumer confidence go down significantly last week, but that's why the market has already sold off like 10 to 15%. So we think today's number important to focus on, but we think the general trend will be negative. We don't think that should set the direction of the market.
It comes as Goldman Sachs, Barclays have lowered their growth estimates for the U.S. economy this year. We still want more clarity on tariffs. How closely are you following the headlines on trade, and is it impacting how you're thinking about where you're investing?
Well, the headlines on trade are very worrisome. The headlines on tariffs are very worrisome. Tariffs are a loser's game, period. Other countries might lose worse than us, but it's not good for the U.S. And the market has finally started to react to that. However, the market is down very significantly at this point. So we think you want to pay attention to it, but you want to look beyond it. We think the best way to be successful as an investor this year is buy the dips, not get caught up in the day-to-day announcements, which is difficult, but then look beyond it. And there are a lot of really good businesses that are selling at attractive valuations. They've been marked down. The market PE was 22. Now it's about 20. There are lots of areas that are 15 or less. So we take a longer-term view. We think that's going to be the key to success, because by the time Trump pivots and starts talking about tariffs, having won and goes on to something else, stocks are going to be a whole lot higher.
So then what is your stock of the day, David?
The stock of the day would be PayPal. PayPal had a very good investor day. They had good earnings. They upped the outlook for the next year, but the stock sold off about 15%. We think you're buying a great long-term business at about 13.5 times earnings. We think regardless of the market, the stock easily could be at $90 in the next 12 to 18 months. And we think longer term, it should be higher than that. We'd say this is a low risk, really good return stock. They're buying back a boatload of stock, which is very accretive to earnings. So they're doing all of the right things.
Stock is down about 19% this year, but you say that this presents a good buying opportunity. What about overseas? I mean, the comments from China overnight seem pretty significant. They're putting together this new special action committee boosting consumption that they hope will boost consumption and aid their economy as they await for tariffs down the line from the U.S. What do you make of it?
So going into this year, we were upbeat about overseas because they had done so poorly for so long. At this point, overseas is up 10 or 15%, with our market down 5 or 10%. So we think a lot of the differential for this year has already been achieved. If tariffs are going to be problematic for the U.S., which is what the market is saying right now, they're going to be problematic for Europe and for China. So we're a little bit less bullish on overseas today than we were. We think the better opportunity right now on say a 6 to 12 month basis is buying the U.S. rather than chasing the rally overseas.
So does that mean tariff is your word of the day, or what is it?
The word of the day is whipsawing, and you're seeing it. Last week, the market was down significantly. Friday was up a lot. Futures are down a lot today. Expect that volatility. Key to success, take a longer-term view. Buy the dips. Don't chase the rallies.
What if Powell says tariffs are not inflationary, that they won't impact growth? I mean, how do you expect the market to respond?
The reality is the market knows that tariffs are ultimately inflationary. We don't think that Powell would weigh in that way. We think tariffs might take a little bit of time to run through the numbers, but without question, if you raise tariffs 25 or 50%, it's going to impact your financials. It's going to impact your price of goods.
Today, CNBC.com reporting that Klarna will now be the exclusive provider of buy now, pay later loans for Walmart, taking away a coveted partnership from rival Affirm. Affirm shares down 8% as a result, and that's off session lows. CNBC's Hugh Sun broke the story, and he joins us now. First of all, welcome.
Great to be here, Kelly.
Second of all, I guess start wherever you think, but what's the backstory here and how big a deal? And is the timing a coincidence just after this IPO?
Yeah, I don't think so. I think they're trying to generate enthusiasm for the IPO. That's pretty clear. So, the mechanism for delivering these Klarna loans, these installment loans to Walmart customers will be, there's this in-house fintech called OnePay that they rebranded to OnePay recently. And that's going to be the front end. On the back end, Klarna is going to offer these loans, and they're going to be ranging from 3 to 36 months and from interest rates of 10 to 36%. So that's the context. Obviously, the timing seems to be very, very auspicious for them. They're generating a lot of enthusiasm for their IPO. They hope to. And if you look at some of the filings, they actually, they gave OnePay, which is the Walmart fintech, about 15.3 million shares in the IPO.
Oh, really?
And so this is how badly they wanted this, Kelly, which is they gave them a huge deal sweetener to make sure that they would ice out a firm and get this really lucrative partnership.
So that's something to keep an eye on when a firm or when Klarna does open for trading, that Walmart has exposure to it. It could certainly benefit from the upside. Also interesting, like you said, though, because shoppers are not going to see Klarna's brand name anywhere on here, which is a big thing to give up.
I mean, yeah, so it's unclear to me if it's completely white labeled or if they're going to mention Klarna at all. Klarna is a brand that resonates with a lot of people, more so outside the U.S. than inside the U.S., and that's kind of what they're hoping to change with this. Obviously, Walmart's the biggest retailer in the country.
Right. So how should investors put their money to work? Well, that's a good question. Joining us live from Miami Beach at the Future Proof Conference is Brian Lake, the Chief Transformation Officer at Goldman Sachs Asset Management. Brian, great to have you here today. What are your thoughts on the market?
Yeah, no, that's exactly the question that we're getting here. We're talking to hundreds of financial advisors that are asking that exact question. How can we incorporate the tools that firms like Goldman Sachs Asset Management offer and help their clients get better outcomes? One of the major topics has been incorporating private assets into their portfolios, whether that's private credit, private equity, infrastructure, or real estate. These are the different types of tools that can help smooth out that ride when markets do get a little bit volatile.
We're going to talk about that in just a second, actually. But I mean, when you talk about the markets being volatile, I imagine you still have people in stocks. Do you make any big moves at a time like this?
No, I think, one of the things that we always talk to investors about is you need to expect that these moments will come. And so how you've built your portfolio coming into these moments is really the important part. And so if you've got a game plan, the deal is to stick with the game plan. There may be some opportunities that the market presents us to rebalance a portfolio one way or the other. But at this point in time, we think just staying invested and keeping your eyes on the long-term outcomes is really where people should be focused.
Brian, you deal with some of the highest net worth people out there, and I'm wondering how the rich are dealing with this stock market downturn in a different way from maybe the rest of us. I mean, they have a little bit of a higher tolerance for stock market pain. Are they looking for other assets to get into? Are they looking for other things to do with their money right now?
Well, one of the things that we're spending a lot of time talking with the kind of ultra high net worth community on is direct indexing and the tools where you can kind of rebalance in moments like this, and it can generate some losses within the portfolio while still giving you exposure to stocks that can actually help you benefit from this. And so some of those losses that you can embed into the portfolio, potentially offsetting some gains later on. We also are doing things in the active ETF space. We've launched some buffer ETFs, which are also designed to help investors kind of get invested and stay invested. The idea is they can protect to the downside when markets do get volatile like this, but still offer upside when hopefully markets do recover.
Are people willing to do indexing when the market's going down? I mean, indexing seems like a great idea when the market's going up, but if it's going down and you're marrying your portfolio to it, doesn't that make people feel just a little queasy?
Yeah, no, and I think that's why we've seen so much growth in active ETFs, actually, where you can take active strategies where you've got portfolio managers that are actively identifying opportunities that the market presents it and then delivering the outcome that investors are looking for. So, for example, we've got an active small cap ETF, ticker GSC, and you're exactly right. The portfolio manager is sitting there looking at these small cap stocks and seeing what are the opportunities that I should identify. I mean, a lot of this market volatility, I think, is driven by potentially some regime change around AI, where, DeepSeek came out and the market's rethinking how they want to price some of the Mag 7 that have been driving our returns for so long. And so what we're seeing is a broadening out of the market and an active manager looking through those opportunities and identifying where they can potentially provide alpha or, of course, provide some protection to the downside is absolutely what we see in these markets right now.
Next guest is starting to see some good buying opportunities, including in the Mag 7. Jeff Kilberg is the founder and CEO of KKM Financial. Jeff, a bit of a warning from Barry just now about, kind of jumping in too quickly and deciding that the market is a buying opportunity. So I'd love to hear how it looks from your point of view. Welcome.
Well, Kelly, happy St. Patty's Day, and I'm looking for a little luck of the Irish today, as I am starting to nibble at some of these names. And I've been super critical as we saw 20 consecutive days of Facebook, Meta, going straight up. You know, I was critical of NVIDIA on that move higher. So I've actually welcomed this repricing, this revaluation of these Mag 7 names. Tesla, let's put Tesla to the side, but let's talk about NVIDIA. I think we're going to see some re-enthusiasm, not sure if that's a word, but we're looking for some re-enthusiasm with this GTC conference, and we're going to hopefully see NVIDIA kind of get the investor base re-excited about the AI theme, which has worked so well. But I do believe there's been opportunity. When we go back about 6 or 7 trading days, Kelly, we saw the third largest put options on the S&P 500. That was the third largest ever. What do we see subsequent to that? We saw massive indiscriminate selling. Last week, it was hard to watch. Everything was getting sold. That is when the opportunity comes about, in my opinion, and I've harped on this a lot on the exchange. You want to be positioned for risk mitigation. You want to be buying puts when the VIX is at 14. You don't want to start buying puts when the VIX is at 25, 28, or even 30. So that's where I think there's opportunity inside of this March Madness, which has certainly happened despite the fact that we haven't had tip-off in the basketball tournament yet.
You were cautious on NVIDIA going back to last summer. It's largely been kind of chopping wood since then. So are you a buyer of NVIDIA now? Are you a buyer of Tesla now? Which of the Mag 7?
So I'm long NVIDIA. I bought it last week and actually aggressively sold those 100 puts. Didn't feel great when it was down at 107, but here we are collecting that premium. Happy to own NVIDIA lower than $100. But at this point, in this moment in time, we've had a nice $10 appreciation in the move. I'm being very tactical. Same as Tesla. You know, I was selling put options in Tesla back in late 2022, January 2023, and I got put to all of those options from 150 down. We saw a sensational move, and I even came on here when we talked about I was selling Tesla at 350 and 400. We were writing calls, even took some of the position off at 430. Almost was getting mocked from some of the folks on Twitter saying I was leaving too much meat on the bone. But that's how you have to be tactical with Tesla. You're talking about a $1 trillion company that's trading like a micro cap. It's up or down 5 or 10%. So here we saw 217, the low last week. I again today have been adding my position because I want to go back to a full amount of what I want to be notionally long Tesla. There's a lot of notes out there. There's a lot of enthusiasm. But I'm still looking through the same lens, Kelly, that Tesla is this AI play. It's the purest AI play. Yes, they have to sell cars. Yes, they have to get some excitement. But I think the emotion around Elon, good or bad, whatever your emotion is, I'm indifferent. It's immaterial. It's providing opportunity. So we're seeing option premiums elevated in Tesla. I want to be a buyer here, but pigs get fat, hogs get slaughtered. If we get back above 300, I'm going to consider lightening the load a little bit, but it's an opportunity to buy more at this decreased price.
All the way up to 300. That's interesting. And Grok, by the way, I think is a real gem, but that's not a Tesla asset, at least right now. So,
well, and real quickly, I'll just add from a forward PE on Tesla. Let's look back in December of 2024, just about 3 months ago. We saw that forward PE traded at 193.
Wow.
When I was selling put options, it was down to 34 in January of 2023. So right now, we're kind of at a 5-year average of 83. I'm not saying it's cheap. I'm not agreeing what the forward PE is. But from a historical perspective, if you want to be tactical in Tesla, this is an opportunity to own it when there's fear, when there's scrutiny, when everyone out there saying, Elon, grab the microphone, say something about Tesla.
Right.
Something, right? That's what we're looking for. So I think there's going to be a catalyst. And even if there's not a catalyst, we're seeing the RSI levels on Tesla go under 30. So we're seeing seller exhaustion. And when you see a short covering, that will be a gap. 30. So we're seeing seller exhaustion. And when you see a short covering, that will be a gap up back above 300, in my opinion.
Prices topped the $3,000 level for the first time ever last week, up more than 13% since the start of the year. Our next guest was talking about $3,000 gold at the end of last year, saying that he saw upside risk from firmer central bank purchases. Join us now with more on gold and oil prices, commodities in general. Also, the energy group after those airstrikes in Yemen this weekend. Don Struyven, Goldman Sachs, co-head of global commodities research. It's not everything in your complexes is headed higher, which is what you'd think if the dollar was weak or getting weaker. That would explain gold, but it wouldn't explain necessarily oil.
So I think the broader driver here is uncertainty and risks, downside risks to the U.S. and the global economic outlook. and that is pushing down some of the more pro-cyclical commodities closely tied to US growth, such as oil, but it's supporting gold. We have seen very significant increases in investor demand for gold, and we're seeing very rapid buying from central banks for gold as well.
If tariffs were going to be really inflationary, then why are you seeing deflationary forces in commodities?
So I think across the commodity complex, you have pretty divergent moves.
Right, so it's not all the same.
Strength in gold,
not all
strength
the
in
same.
copper, softness on the oil side. And I think the main driver here is that we are expecting somewhat higher inflation, not because of a boost to global aggregate demand. It's primarily because of tariffs, which you can think of.
Well, where should we be seeing that then in the commodity complex?
Well, I think what's really interesting is that commodities are front and center in tariff policy, and so investors who want to hedge themselves against tariff escalation, I think, could either go for gold.
But didn't you just tell me, Don, that commodities were weaker, except for gold and other things? So that's why aren't they sniffing out tariff inflation?
U.S.-based commodity prices, for instance, in the metal space, have risen on the back of expectations of tariffs. I think one key priority for the U.S. administration is to boost domestic availability of both energy and metals, and therefore commodities are key targets for tariffs. And so you're seeing upward pressure on U.S. prices, for instance, of copper. You're seeing upward pressure on gold, given all the uncertainty about the economic outlook. So it's very much an environment where you want to be selective in your commodity portfolio allocation.
All right. You would expect other commodities to rise, grains, et cetera, from lumber, I don't know, things from tariffs at this point. Where's the index itself, the CRB, in terms of, is it off its highs? Where is it?
Yeah, we're up modestly, but with a lot of divergence under the hood.
Under the hood. You have an objective for gold long term?
So our forecast base case for year end is $3,100 per troy ounce. But we think that the risks to this base case and to our 3,100, 3,300 range are skewed to the upside. We have seen, it's pretty remarkable, we have seen a rally despite a decline in speculative positioning. So positioning is a lot cleaner than before the rally. And the reason is that investors, ETF holdings, have jumped. They have added 100 tons of demand over the last month. And central bank buying continues to be very strong. In January, central bank buying was 7 times higher than the pre-2022 average. Central banks across the world are worried that the dollar and Treasury holdings may not be.
I was going to say, is it a concern about Treasury holdings too, U.S. Treasury holdings?
Yeah, and what you're seeing right now is that several G7 countries are suggesting not only to freeze Russians' reserves, but actually also to seize them. And if you're learning that dollar reserves are offering bargaining power in those kind of international conflicts, in the context of discussions of a ceasefire, it probably reinforces the willingness of EM central bank managers to pile up on gold.
Is drill, baby, drill the reason oil prices are weak, or is it because of growth worries globally? And China was strong, wasn't it? Are they cooking the books to look strong for the tariff onslaught, or what?
If you plot oil prices year to date against what we call a U.S. growth factor, which basically tends to decline when yields go down and when equities go down, the correlation is very, very tight. So the main driver here of softness in oil prices is concerns about the U.S. growth outlook. We also think that some pricing in of a ceasefire and easing of Russian energy sanctions has also weighed on both oil and natural gas prices.
Dollar getting weaker? Is it going to get weaker, the dollar?
Or FX strategists.
You can't say? You got the poor FX strategist is going to get in trouble if they screw it up. Never mind. If you don't have an opinion, I don't care. You don't have an opinion.
Or FX strategists, have downgraded their dollar views, both because of the positive growth news from Europe, with Germany defense and fiscal spending, which, by the way, I think is another reason to be constructive on industrial metals demand.
Okay, what's up, guys? Hold on. Let me get my shit together. All right. Okay, got back. So, okay, played some videos. You got some things about commodities. You got some things about gold. You got some things about Klarna. Buy now, pay later. It's March 17th, 2025. All right. So, let's see what we got here in the markets today. Not much today, I think. Not too much. Everything from last Monday still a lot. Got some pullback on Nvidia and Tesla. Some pullback on MSTR. Okay. But a lot of small caps moving on, moving forward. Okay. See how that goes into Powell. To wait for that. SOXL doing pretty well. So semiconductors following Intel. Intel is helping things out. Now tomorrow at 1 should be at 1 p.m. Eastern, 10 a.m. my time Pacific. Nvidia is going to have a keynote address by Jensen Huang, the CEO of Nvidia. So I'm not sure how much that will pump anything, really. We'll see. But Powell will be the main focus on Wednesday, okay? That'll be the main focus. So let's see what's going on here. And I have some stocks to talk about, some utility stocks, actually. Interesting news from the utilities. Interesting. So let's look at the semiconductors right now. Let's look at that. If we get something. Oh, come on. StreamYards, come on. Hold up. Okay. So we're right here, right now. At this daily 18, right here. We touched it. We touched it at 207 SOXX. See SMH. See how that one's going. Yep, same thing. SMH 228 touching that 8. Okay, yeah, we're at the precipice. Whether this continues on or drops from here, I have no clue. If you're a big fat bear, you would say tomorrow would be a failure. It would rush back down to 213. So we'll have to see how it goes in that keynote. Let's see. Intel right now, still going off the CEO news, going off of all the, I don't know what other news there are. Probably more than that. I'm not paying attention though. But yeah, we're back up here at the over 24.73 range, right? So 1950, 24.80. That's the range we've been in since we dropped here in August. Back and forth, back and forth, back and forth, back and forth. Next earnings will be April 24th. Interesting date, just after tax day. So very curious what it will do. Maybe, all this stuff here will resolve eventually. I'm expecting like you can probably get lower prices. Yeah, you probably can. Maybe this thing will try to fill up a gap here at 29. How about that? And then after that, we'll go down lower from there. Possible. Anything's possible. Okay, so let's look at SOXL. Pretty good. So 5%, probably 6 to 7% today. Intraday market. So let's see. So if you got here on Monday, right around here, Monday or Tuesday, either one, let's say you did 17 about, you're up about 25% on SOXL. Okay. Now, let's see what else we got here. SMCI, did that follow today? Nope. No, nothing. It did nothing today. So nothing there. So let's see what other stocks I want to talk about. Intel, I talked about that. Let's look at Hawaiian Electric. So I was talking about this one. It had a nice pump last Friday on March 7th. Okay. We went back down. Then it pumped again March 14th, week later. Now we're here. So should I add or not? That is the question. If you guys got in at 8 to 9, That's pretty good. Now you're wondering, should I add? That's what I'm wondering too. Today we got PCG now back at 17, Pacific Gas and Electric. So another wildfire type stock here. And then the latest wildfire stock, Edison International, Southern California, up. And it's actually up on bad news. Quite interesting. We have bad news. We have some confirmation that it started one of the fires in Southern California, but it went up anyway. How is that possible? Anytime I see bad news make a stock go up, that makes me more and more curious. It's just like the tariffs on Mexico. So EWW. So we've been bouncing up and down from 47 to 53, and now we're back up to 53. So when bad news stops pushing this thing to a lower price, guess what's going to happen? We're going to break out pretty soon. So should I add or not? Another question for me to ask. So MEXX is 3x leverage of EWW. It's at $12.66. Okay. So I'm thinking this can double. So it can go up to 20 something shortly. So yes, I am bullish on Mexico, despite everyone telling me no. And same thing with China. I would say like China right now, we have earnings on Tencent this week. We have Baidu having AI noise. They're talking about their new AI. Should you buy it now? No. I've been selling on the way up. I am waiting for Tencent and Powell and the Bank of Japan to see how this goes. I probably would not buy here, but I may recommend it again another quarter later. Okay, so I wouldn't be chasing right now. I think it's too late if you haven't been in China since last year or most of the first quarter this year. It's too much. This is too much, I think. We had a lot of bad news from China like over the weekend with the economic report, but as I said, when bad news stops affecting something, then that means you run out of sellers. Nobody's willing to sell anymore. So now you're wondering, well, are there new buyers? Are buyers willing to pay at a higher price right now? That's the question you should be asking with Mexico and China. So let's look at Tencent. Tencent. TCE, HY is Tencent. They will have earnings on Wednesday. Okay. March 19th. What's the other one? TME. Tencent Music Group. Tuesday morning, tomorrow. Okay, TME. So watch those. What else we have? So let's look at Baidu. Baidu had the AI stuff. So their news pumped it up here today, 9%, but we're still in this range. You can see this range between $80 and $100, and it briefly got over it to 114. Will it do it again or not? Are we still in this holding pattern? That's what you got to ask yourself. So watch these BIDU. Now let's look at gold. So gold reached 3,000 today. ORLA is one gold stock I haven't mentioned yet, but I did put it on my watch list. It has done quite well, actually. So from February, it's been going sideways, even though gold mining stocks have been moving down. And now we see it break out on March the 11th. So since that time, let's see, how much has it gone up? So 20%, about 20, 24%. It has earnings tomorrow, maybe. I haven't double checked this. This is what TradingView has said, Tuesday, the 18th, March 2025. So I'll have to see if that's true or not tomorrow. I don't know if it's before the market opens or after. Let's see what else we got here. Let's look at Tesla, since we talked about Tesla a bit on the video. You see here it's trying to form a range. So let's see what we got here. Tesla. Yes. So we're now in this range. So you see this big red candle here on the hourly chart based in March 10th. We're pretty much in this area now, defined by this area here. We've gone below, we've gone back up, we've gone back here, we've gone back up, now we're back here. So where does it want to go? I don't know. We have to wait for Powell, I think, to resolve this question now. That's it. Everything now is on Powell. See what else we got. CCJ or something like that. Let me see. What other stocks we got? So GDX, let me look at GDX. Let me look at the gold mining ETF. So it's broken out of 42 here. Good. Now, let's see. It's looking like it took out the old high of October 21st. Good. Let's see how high it goes. Okay. So we have Orla, ORLA. You got that. You have GDXU. You can use GDXU 3x leverage on this. It was up 7% today. So, yeah, that's possible. You can see if it can get up even higher than that. Okay. And then we have BKV Natural Gas Utility. Had an IPO back in October, September last year. It hit that price again at $18. It's up to $20 now. Let's watch this. This might be the area where it fails again. I don't know. I think if the stock market does go down, I will be watching to see how low it can go, because this is a new stock. We don't have any history. All we know, it went from 18 to 26, 27. It's back to 18, went to 20 now. Now does it pull back? So BKV, watch that one. And then let's see what else. GEV, General Electric, Veranova, the nuclear split off of the main General Electric company. And we hit here at 269. We got back to 311, and now we're going back into this range at 332. Today is up 5.84%. See if it gets to 350 and pulls back. If this thing is going to go lower towards this earnings, I'm watching this. So GEV, watch this one. Okay. Next one, CELH Energy Drinks. Okay, Celsius. So this was an old favorite of mine's back in the day when it was like around here, right? $2, $1, $2, $3. It went up to like 30 something. I didn't buy much of this one. All right, it's an energy drink stock. So it's gonna move up and down just based on preference here. And if the economy is going down, I don't know how many people are just gonna buy this trash drinks. But it does seem to try to want to get to 32 and keep fighting in that area. Okay. So we got to get down to about May 13th. Okay, that's where the next earnings is. So let's see if we get to 32 here. Okay, now let's see what else we got. ERJ. This is Embraer. This is a Brazilian airplane stock I mentioned several times already because it was hitting this 48 area. This 48 area is very important. This was a top set back in June of 2007, and several weeks already we've been going up, up, up above it. So yes, there are a lot of international stocks, defense stocks, airplane stocks, all kinds of stocks that are doing quite well. Even though the U.S. market itself looks weak, you should be thinking international now. I don't know how long this will last. This might just break down. But if this thing holds, if we hold this 48 area, then yeah, I expect higher prices shortly into the next quarter. Another one, let's look at electric vertical and takeoff landing stock here. ACHR. This is my favorite one. It's very risky, very volatile, but it's been holding 7. It's been holding 7. It's been holding 7 several weeks now. February 24th, March 3rd, March 10th. It's been holding that. So that's a good sign. That's a good sign. So ACHR, I'll keep watching this one to see if I decide like, yeah, it's time to add more. And if the market is going down, yeah, you can wait till April, okay? These are just things to watch. Okay, HB said he was playing copper. Okay, this is interesting. FCX. All right, it's been doing this thing around 35. This was an old area of support. That's true. Because if we look back here, 31 is probably where things could possibly go worse. Okay, we'll watch it. We'll watch this. I think this depends mostly on the Chinese economy. Maybe some tariffs. I don't know. There's no tariffs on copper yet. There are tariffs on steel and aluminum, however. Alcoa. So this thing's been in a range for quite a while. It's only reached its maximum from COVID into 2022 at 96. It's been stuck in this range since 2022. So yeah, okay. Let's see how that goes. Germany stocks. Yeah. So last week it returned here. That was good. 23% last week. Now, I think this will be a blow off, though. This will definitely pull back. I would watch this over the summer. So this is Rheinmetall, RNMBY. We talked about this and some other European stocks. And yes, that may be worth buying, but I think, yes, Europe has done this before where they kind of like have this nice move up and then they do a blow off and then it just pulls back like crazy and then people don't want it anymore. I don't know. I don't know if this is going to be a sea change. The politics in Europe is changing because of Trump. I don't know if this is going to be long lasting. Let's see. The last one we're talking about, steel or aluminum. I think this is an aluminum one. It's a smaller aluminum company since they talked about Alcoa, AA. Century Aluminum Company, CENX, at $20.45. It's been around this top since 2014. Let's see. Yes. So even 2011. So this area is going to be troublesome. It's been building this range since then. I don't know if this is going to go up or not into next year. But yeah, okay, I'll watch it. CENX, Century Aluminum. Yes. Okay. Now let's see. Done. All right. So tomorrow we'll have to watch NVIDIA, NVDA. And if you're playing it, NVDL 2x leverage. Okay, for NVIDIA. So far last week, we've gone up already 15% plus. NVDA, let's see. How high could it possibly go? If we go on the weekly chart, maybe it'll go back up to 230, 229. I mean, 129, 130. Okay, let's see the hourly. Yeah, okay, still doing all right. Not good today, but still holding on this trend. All right, on the hourly. Okay, good. So let's see what happens tomorrow when they do the keynote. Okay, let's see. Last thing, let's talk about the fires, all right, with California and the blame game. So EIX, if you guys been in here, I bought here at 55, 56, okay, in this area. Somewhere here, all right? Then I bought more here when I started doing this, right? Started going to 52 to 50. Buy up here. Now it's back to 59. Higher than when I bought here and here. So should I buy more? That is always your question. When you see this base forming, this is a base. Should it be time to buy? So let's play the video, and I'll let you be the judge.
100-year-old long unused transmission line is now suspected of sparking the Eaton fire in Altadena. As investigative reporter Jackson Vanderbecken tells us, regulators called for the abandoned line to be removed, but the state's utilities want a key exemption.
The electrical tower you see in this cell phone video of the Eaton fire hasn't been used in decades. SoCal Edison says it disconnected it from its power grid back in 1971. But left the lines up. Investigators suspect extreme winds pushed a nearby live line close enough to energize a neighboring dead one, which sparked the Eaton fire. This video simulation, commissioned by wildfire lawyers suing Edison, shows a flash atop that tower and fires starting below. Since 1922, state regulators have mandated all abandoned power lines be taken down. But in 2005, the rule was altered, allowing unused lines to stay up unless utilities themselves determined that they had no foreseeable future use.
This is ridiculous.
Former Public Utilities Commissioner Loretta Lynch says the rule change was like a get-out-of-jail-free card, letting utilities keep potentially unsafe idled systems in place by simply claiming they might need them later.
This should never have happened, that the PUC allows the utilities to decide what's abandoned and what's not, based on what's profitable to them and what's not.
All electric equipment by its nature is hazardous.
Former CPUC law judge Stephen Weissman, who teaches at UC Berkeley's Goldman School of Public Policy, reviewed the circumstances of that rule change for abandoned equipment and says safety wasn't even mentioned.
Safety is not something that can be compromised, literally, and yet that's what they've done here.
He says the rule change came after Edison was fined by regulators in 2004 for failing to remove an abandoned transformer involved in an electrocution death, rejecting Edison's argument that the equipment wasn't actually abandoned, just left for future use. 2 decades later, armed with the 2005 rule change, Edison is using the same justification for leaving up its idled Mesa Silmar tower, telling us in a statement, "There are many reasons we would keep an idle tower in place, including the potential need for more transmission to meet electrification needs of the future. It is important to remember that we inspect these idle facilities regularly."
If this line is sat idle for 6 decades, what makes you think you're ever going to use it?
Weissman not only doubts the need to keep the system up, he questions how seriously the utility was checking its long dilapidated equipment.
Did they go through any kind of a theoretical exercise to figure out how this particular abandoned equipment could cause some sort of a problem? Or did they just sort of fly by in an airplane and say, well, it's still there?
Our review shows Edison doesn't list the Mesa Silmar line as being one of the transmission systems it needs to keep free of brush and trees to avoid sparking fires. And Weissman wonders if regulators will rethink the rules about abandoned lines following the Eaton fire. The Public Utilities Commission declined to comment, citing their ongoing investigation. Jackson Vanderbecken, NBC, Bay Area News.
Well. All right, guys. Well, what do you think? What do you think? Legally, they're in the clear. And guess what? Politically, these utility companies are monopolies. And I know California pretty well. It's pretty damn corrupt. So I think a lot of these guys have already bought and paid the politicians to look the other way. So yeah, maybe they'll get a little slap on the wrist here or there. And the market already knows that. And that's why even with that bad news that they could have potentially started that fire anyway, it's up 3 to 4% today. So when you see something that's quote unquote bad news and the stock goes up, you got to pay attention. You got to think to yourself, wait a minute. So that means everyone who sold with the most fear that things would be so bad that they would be blamed for a fire down here at $50. Now it's back up to $60. Guess what that means? They're in the clear. They think whatever they're going to get, whatever punishment this company is going to get, isn't enough to bring it down even lower. So that's what I was betting on. I was betting on corruption. So if you guys were buying down here, you're safe. Even if you bought here early at 56 like me and then bought more, you're great. Now you're at 59 to 60. I'll see you back at 70 and 80. That's how it works, guys. That's how it works. So always pay attention when the news doesn't make things worse. Okay, that's the only time I'll pay attention to news. It's when I want to see as much bad news as possible. Then I'll look at the chart. I want to see the reaction. I want to see what the market thinks about that news. If that news doesn't do anything, then you know you made it. You got the bottom. All right, let's read some articles. Okay, and I'll see what I can say about those. We're almost at the hour mark. All right. Let's see. Okay, let's look at... Oh, I have some cycle analysis here. Let me look at the cycle analysis. So I'm going to look at copper since... let's see. Let's look at copper here. So this is the weekly copper cycle analysis. So let's see what HB is doing here. You can see this thing moving back up here, making a cup from May of 2024. It's moving up copper futures. But on the cycle chart, it says we're still going to move down until next year, April 2026. Now on the daily, let's look at the daily. Okay, that's set, right? Okay, we got two cycles at 152 days and 264 days. So we're near a top, apparently. So I don't think we'll be going back up until maybe late June to early July into December. Probably going to follow gold a bit. So that's why I'm kind of cautious. People are just keep pumping gold. I'll be very cautious. Look at gold, okay? I think gold will go up, but immediately be suspicious. Because let's say we get to 3,500 per ounce on gold, watch copper, watch the steel, and see what happens. These are the base metals. They'll follow like the precious metals for a little while, and then it'll break down. Also watch silver. Silver almost touched $35 an ounce. I don't know if it will hit 40 to 45. It might. So watch that too. Okay, and then let's look at the retail sales data today. Retail sales in the U.S. increased by 0.2% month over month, rebounding from a downwardly revised 1.2% fall in January. So this is a February reading, but well below forecast of a 0.6% rise. 7 of the reports, 13 categories saw declines. Okay, so food and services, drinking places, so bars, essentially restaurants, down 1.5%. Gasoline stations down 1%, clothing down 0.6%, motor vehicle and parts dealers 0.4% down, sporting goods, hobby, musical instruments, bookstores down 0.4%. Miscellaneous store retailers down 0.3%, and electronics and appliance stores down 0.3%. In contrast, sales of non-store retailers, what does that mean? Non-store retailers. So Amazon basically recorded the biggest increase, 2.4%, followed by health and personal care stores at 1.7% up, food and beverage 0.4%, general merchandise 0.2% up, building material 0.2% up. Sales at furniture stores stalled. Meanwhile, sales excluding food, services, auto dealers, building material stores, and gasoline stations, which are used to calculate the GDP, jumped 1%. Reversing a downwardly revised 1% fall in January, and much better than a forecast of 0.2% rise. So mixed messages there. Mixed messages. Now let's look at the Chinese Baidu AI stuff here. Let's see what we got. Oh, come on. Jesus, just load. All right. Oh, it's called Ernie. That's right. China puts American AI industry on notice yet again with Ernie X1, Baidu's new open source reasoning model, written March 16th, yesterday on the Sunday, 2025. Chinese tech giant Baidu, stock ticker BIDU, released open source AI models, Ernie X1 and Ernie 4.5. The company says the models rival those from OpenAI and DeepSeek, performance per cost. Okay, Baidu, China's answer to Google, has released 2 new AI models. On Saturday, Baidu released Ernie X1, a reasoning model it says delivers performance on par with DeepSeek R1 at only half the price. It also announced a multimodal foundation model called Ernie 4.5 that the company says outperforms GPT 4.5 in multiple benchmarks while priced at just 1%. 1% of GPT 4.5. Baidu said it's also making its chatbot, ErnieBot, free to the public on April 1st. Oh, April Fools, ahead of schedule. The tech giant said it will progressively integrate Ernie 4.5 and X1 into its product ecosystem, including Baidu Search, China's dominant search engine. Baidu's new releases come as Silicon Valley reckons with the cost of AI models, largely spurred by latest drops from DeepSeek, a Chinese startup launched by hedge funds High Flyer. In December, DeepSeek released a large language model called V3, and in January, it unveiled a reasoning model called R1. The models are considered as good or better than equivalent models from OpenAI, but priced anywhere from 20 to 40 times cheaper. Okay, guys, you can read this yourself. I'll read this here. Okay. And that'll be it. All right. Let's see what else we got. See what this thing says. Man, it's all blurry. Oh, God. I'm supposed to read this thing. Can these guys do better resolution? Oh, my God. 28 cents per million tokens. What the heck does that mean? $1.10 per million. I don't know what this means. Okay, whatever. You guys can screenshot it. I'm not an AI expert. I don't know what the heck that means. Okay. So you guys can go to the article yourself. Let's look at Intel. Intel's new CEO mulls manufacturing strategy revamp. Incoming CEO Lip-Bu Tan is thinking of carrying out key changes to the company's chip manufacturing methods and AI strategies ahead of his return to the company on Tuesday, Reuters report, citing people familiar with Tan's thinking. The potential measures include revamping the company's approach to AI and job cuts to address what Tan sees as a slow-moving and bloated middle management layer, restructuring the company's manufacturing operations, which once only made chips for Intel but have been repurposed to make semiconductors for clients such as NVIDIA, is one of Tan's main priorities. Intel has been missing a permanent CEO following the abrupt departure of Pat Gelsinger in December, but last week the embattled chipmaker appointed Cadence Design Systems CEO Tan to take up the role. Tan joined Intel's board in 2022 after a decade leading Cadence, but quit Intel's board last summer over reported disagreements with Gelsinger's turnaround plans. Tan told staff at a town hall meeting after his appointment that Intel would need to make tough decisions, report added, citing people briefed on the meeting. In the near term, Tan intends to improve performance as manufacturing unit Intel Foundry, which makes chips for other companies such as Microsoft and Amazon, but aggressively trying to win new customers, the report noted. The company will also restart plans to make chips that power AI servers and look to areas beyond servers like software, robotics, and AI foundational models, according to the report. All right. You guys can read that article here. Okay, just a little bit time left. Got 5 minutes until up to the hour. Okay, let's see. What's the next one? Let's look at the utility stocks again with this. So I'm going to read the Wall Street Journal to sum everything up. The prime suspect behind California's Eaton fire, a zombie power line. So if you guys remember, they had bad news a couple of I think weeks ago or something. And I was like, well, you know what? There's going to be some big news coming. Now, let me read this. An investigation by utility Southern California Edison is increasingly focused on whether a decommissioned line was re-energized, sparking a deadly blaze. In the days after the deadly Eaton fire in Los Angeles, investigators at Southern California Edison were all but convinced that none of the power lines the utility operates in the area had sparked the blaze. Evidence is emerging that they might have overlooked an unlikely culprit, a dead power line unintentionally brought back to life. SEC is zeroing in on an idle power line near the fire-ravaged Altadena neighborhood, where 17 people died in January. The line has no connection to the power grid, but the company is concerned that it may have started the fire. Company executives say investigators are trying to determine whether it became energized through a phenomenon known as induction. So, if you guys know about electrical engineering or physics, you would know that a current passing through a wire can mutually induce current passing through a nearby wire. Okay, we currently have a lot of attention and focus on the induction theory. All right, blah, 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 blah. Okay, the possibility that an energized power line ignited a wildfire, a very uncommon occurrence, has jolted SCE into doing more to assess that risk. Pizarro said the company has about 465 miles of transmission lines no longer in use, and that it is reviewing its safety practices and expecting and maintaining them. The investigation's conclusion will be enormously consequential for SCE, a unit of Edison International. It faces billions of dollars in potential liability costs if its equipment is found to have ignited the fire. The blaze destroyed about 14,000 acres and more than 6,000 homes, making it the second most destructive fire in California history. But here's the caveat. SCE could tap a $21 billion fund established by the state to help utilities manage liability costs tied to destructive fires. So thank you, PG&E, up in Northern California. But to do so without reimbursement requirements, it will have to prove to state regulators that its maintenance of the idle line was reasonable. Uh-oh. So that's the key, right? So you heard the video. They said that it was legal that they could do this. So as long as they do the bare minimum, they can get the get out of jail free card. And that's why these monopolies can get away with everything. And you should just buy monopolies because they just go up and up and up until they can't bribe any government officials. But these companies, as we know, bribe Gavin Newsom and everybody in the state legislature in California to get away with things. Hey, what's up, Roller Stater, Texas girl? All right. Anyhow, I think you guys can read this yourself, okay, here. And that's why the stock went up on this quote-unquote bad news. I like it like that, right? You like to see that when stocks do like this. Usually on good news, a stock might go down. On bad news, a stock might go up. That's when you know it's hit a bottom or top. All right, I'll have another one here. You can read the Fire and Safety Journal of the Americas. Despite risk, a rule change allowed long idle line tied to Eaton Fire to remain. A regulatory rule change 2 decades ago allowed utilities to keep up unused, potentially hazardous electrical systems like the one currently being invested by as sparking invested. Okay, whatever. Sparking the Eaton Fire. The utility says it is investigating whether its Mesa Silmar transmission line, idled since 1971, may have somehow become energized in high winds, touching off a fire at the base of a tower above Altadena. All right. Under the 1922 regulations, utilities were required to take down abandoned electrical equipment so as not to become a public nuisance or a hazard to life or property. In 2004, Southern California Edison was fined for violating that rule in the 1998 death of a man in Lancaster tied to a transformer the utility left up months after a nearby home was demolished. Regulators imposed the fine after rejecting the company's contention that its equipment wasn't abandoned because it was left in place for future use. But that rule was changed in 2005. Oh, how convenient. As part of a rulemaking negotiation at the CPUC, the California Public Utility Commission, the definition of abandoned equipment that had to be removed was changed. Under the new language, the removal requirement was limited to permanently abandoned equipment that owners determined had no foreseeable use. Well, well, well. Thank you, lawyers. We love lawyers so much. Lawyers are so great, don't we? And that's how it goes. Corporate America wins again, and I think this is a big deal because I think Edison can run away from their responsibilities in the coming months. You will see. They'll go through court, they'll go through the arguments, but I think they'll win. And that's just how it is. And I think the market sees that. The market sees that they will win. And that's why you should buy EIX. It's a utility stock. It's in California. California is a big sector of the power market. So if you are big on utilities and you think that's a good place to hide your money during the market gyrations as we go now, then yes, EIX is the way to go. So I've been buying at 50, 56, It's going to hit 60 and maybe it'll get back up to 80. I don't know, but yes, that is the way to go. All right, guys. I think that's a lesson for y'all to look at where stocks are moving. If they are very aggressively selling or buying, it's going to be very interesting to see. And we are not done yet. We have Powell in a couple days. We'll see how that goes. Around 2 p.m. is when the FOMC will release its report. So press release on Wednesday at 2 p.m. Eastern, and then 2:30 Eastern, Powell will begin talking. Watch how the market goes, and then we'll have Max Payne into Friday. Okay, so the market could technically bounce up all the way into Friday. Watch where it is on Friday, then prepare to sell into Monday next week if there's something that'll come up. But you could sell on Friday to prepare yourself for the weekend. No problem with that. It's always good to take some profits. Okay. All right, guys. I'll see you tomorrow. See what happens then. I don't think anything will happen then, so I don't think I need to show up tomorrow, but we'll see. All right. Later, guys.
Feel like I should, feel like I should, feel like I should, feel like I should go. Go. Feel like I should go. Feel like I should, feel like I should, feel like I should, feel like I should go. Feel like I should go. Feel like I should, feel like, should feel like, should feel like I should. Feel like I should go.